This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil with Invest Like a Pro. I want to give you a stock market update as of Thursday's close for Friday morning. Just talk about the changes in the market conditions. There weren't that many, but there's a few things going on that are actually really important when it comes to price structure. So we're going to go through that today. Let's just look at it. And I like to start from this bottom area, the sentiment number, which it dropped again. We have fewer bulls. We went from around 49% bulls down to about 46. The difference between the two is 22%. And I would classify it as neutral. If we get a drop, we were hoping for a rally up, that we'd get a good enough rally and get this overbought. It stayed overbought. In fact, it wasn't even overbought when I was looking at it last Thursday, but based on Friday's close, it was good enough to get that overbought. But we didn't get this number too bullish. Okay, so we really just haven't had a good signal when you go through. This was the last really good signal. Other than that, we've been chopping around in a meandering along without any violent moves in either directions, and no sentiment number getting too overdone. So the overbought oversold oscillator is at 46, basically neutral right in the middle. After being overbought, it's already starting to come down just in 1 week. It's a 5 RSI, so it does move pretty quickly, but it's kind of tough for it to get overbought or oversold, and we've seen that. We really haven't had an oversold reading again since late last year. So we want to be on the lookout for one of two things, either getting too overbought and too bullish, or too oversold and too bearish. And then what we do is start to look for signs of a reversal on like a daily time frame, or if you want to be aggressive, you do that on the hourly. So that's how I would use those in our favor. Now, the volatility hasn't really changed, although we're starting to see a slight increase in the daily volatility, but it's still below its moving average. So it qualifies as still being positive right now. If this crosses above, it'll go to neutral. If the blue line, the 18 MA of the ATR, cups around and turns up, then that would turn this negative. So we want to just be on the lookout for that. But if you look at the weekly, it hasn't even budged. So I'm still of the belief that there's probably pretty good support underneath. There's a couple of critical things that are going on the daily chart that'll tell us whether this 3,800 area is going to become more at risk coming up here in the short term. But when it comes to the volatility, we're not seeing the signs of increased risk, where the volatility is telling you there's distribution in place and there's a lot more risk in the market. So it usually takes place before we see a market drop. Sometimes it happens at the same time, but at a minimum, you would think you'd get some increase in volatility and then a retracement back that fails. Okay, so that's pretty much the update on these columns down here. Let's go through what's taking place on a price and momentum basis on the spider. Now, what I want to do is, I don't have a monthly chart up here. I've got a yearly bar. Okay, now it does show the 18, but it's not quite as important to me as the 4. You see this 4 here? Notice what took place. We had a start to the bull market. Here's the bear. 2008, 2009, we bottom, and we move up, we consolidate with some small bars, and then start to move higher in an orderly fashion. Inside year, move up, nothing too big. Actually, when you got a bigger bar and it got a little away, it came back to the 4, right? Now, look at what happened here. We had this move up, and then we got COVID, and but when it was all said and done, the 4 basically held in here. Now, what happened recently is we got another move really far away from the 4. And in case you don't know, I go through this in detail in my course, the certain things I'm looking for in each bar. Now, the reason why I'm bringing this up right now is that we had this huge move to the upside, and it was the biggest bar in the whole bull market move to the upside. And I would basically say, we've held above the 4 essentially throughout this whole period until we finally closed below it last year. So what I wanted to point out is that we have this move up and then a move down. It almost looks like a bear 180, right? We've got a bull bar up and a bear bar down that's basically the same size. We do have a little bit of a tail here, but when you look at the body, the whole body of the candle, they're basically around the same size, and they're big bars. They're the 2 biggest bars in this whole period here. And so what would I say about this? Well, I would say that the midpoint of these are incredibly important. So I create this, there's an indicator, low, high, middle line. And so if I put this over here, we can see it'll read right next to it here. It's 420, basically 422 is the midpoint of this bar, and obviously on the spider, and then it's 414 for this bar. So if we kind of average the two, we're somewhere between 414 and 420, somewhere in that range in there. So why is that important to me? Well, it's kind of funny. That's the midpoint of this reversal. So a lot of times what I expect is a move up to the midpoint when you have these big bars. This is incredibly important, the midpoint of these 2 bars. We've essentially gotten up to that level and we're struggling to get through. If we can get through that, that would probably be a really good sign. If we fail here, then there's a lot of risk. Why is there so much risk? Well, the fact is that we're below the 4 right now. If you notice, we have spent some time. Obviously, in COVID, we were down there. This opened up the year below and then got right back above. This did spend some time above, but it closed above. This is the first time we've closed below it in this whole move. So there's a couple of things taking place. We got some big bars after a big run. Right. And then we've closed below the 4, and we've got this midpoint to deal with. So it's nice to know that if we look at that, we can use that to our advantage to confirm what we're seeing on the smaller time frame. So I like to do that. I like to look at it. I know I haven't brought this up in a while, but I do think it's an important aspect to do an analysis. Not like you're going to trade off of a yearly bar chart, but if it can give you some confidence as to where the key resistance levels are by looking at the major bars, the bars on the chart, then that'll really help. Now, if we go to the monthly, we're back to the 18-month line, continuing to struggle to try and get through that. It closed on a weekly basis for the first time above it last week, and now it's getting hammered right back below. We're still caught with MACD below the signal line, but above the 0 line. We have no momentum condition in place. This is clearly neutral for me. I don't have any strong conditions in place based on DI, and the MACD, I would say, is a lot more bullish than it was in early 2022, but it's not what I can't call it bullish yet. All right, let's go to the weekly. This is where it starts to get, I think, a lot more interesting. What I've been talking about for several weeks now is we have a 1 here, which is the break of the downtrend line. A 2 is the test of support, okay? And we definitely have a 2 because it rallied off of that level. And so we have the 1 and the 2. We don't have the 3 until we get back above this line up here. And look at what happened. We just got up to that, and it looks like we're failing. Now, the biggest problem with this up move, there's a couple of things. Number one, we don't have great momentum. I do see that the MACD is above the 0 line, but look at how this green DI is so much worse. This is a double top, and this is a lower high. It's not what we'd be looking for if this is getting ready to take off. So that's number one. Number two is you go and look at something like the IWM. I did a show today on Stock Talk for Stock Charts TV. I talk about the IWM and the reason why it's so valuable, because it's going to tell us whether it's broadening or not. Are there more stocks participating? And right now, it's trading so much worse than the S&P, and that's just not a really good sign. So don't get over. So we can get a move to the upside. We can break out even if the IWM is trading poorly relative, but it's not going to take off unless we see improvement on an IWM basis versus versus the SPX. All right, so just keep that in the back of your mind. If the market breaks out, go look and see what's going on with the IWM, and it doesn't mean you can't do some trading to the upside, but if we're going to get a substantial move, we should see a broadening effect taking place. All right, now I've given you the bull case, the break of the trend line, the test, and the move to the upside that has not completed yet. But look at what's taking place on the other side. We broke this trend line, and now we've moved up, and we're making a 2 now. It looks like, especially if we have a poor day Friday, then we have basically created a 2 up here, a test of this high. We'd have to come back down through here to create the 3 to the downside. Why is that so important? Well, if we come take this out, there's a very, very high probability we're going to come test these lows. All right, now we want to keep doing this in multiple time frames. So we've had this rally from the low on March 13th low up to where we are right now. Now let's go evaluate the daily chart. Look at what happened. We have a trend line in place, and if you notice that trend line, you can't even see the 18 MA. You see how the 18 MA and the trend line are the same? Again, right out of my course, this is what you want to know. If you're drawing good trend lines, most of the time the 18 will be parallel, very close. It won't always be exactly like this, but it'll be pretty close. Now, if you know, so that's the 1, and then look at this test. It actually exceeded it by a small, dinky little margin that still qualifies as a 2. Now, we've definitely created the 2. What we're missing is the 3. We're sitting on the line that would complete the 3. A break of this, I'd probably like to see it close that way, close below the 40, close below this line. But the reality is that if we get back below that line, it's a pretty big negative. And what does this tell me? Well, this tells me that increases the odds that we want to come down and test the next support zone. So if you think about it, the weekly line is down here for the 3. All right. This line is right here. So if we get a convincing break of this line, then that increases the odds that we're going to come down towards this 3,900, 3,800 zone and put a lot of pressure on this next key level, this next key horizontal trend line. So the other thing I wanted to point out is that we had this move to the upside. It made a marginal new high, but look at what MACD did. You see how that failed to get above the signal line? So that's essentially a pinch play that is a divergent pinch, meaning we have divergence in place because we made a higher high here, this made a lower high, and it's a pinch play. So the way to you'd look for a trigger by going down to the hourly chart. Now, truthfully, I try and be pretty straightforward with what's going on here. If you look at what's taken place on the hourly, the problem with this and the trigger point right here was with the Fed. I mean, the Fed announced, and this ended up being when the Fed was, they announced at 2 o'clock, and then by 3 o'clock he was done speaking. It had a pretty big drop by the time he was done. It's just really hard. Well, let's just take a quick peek at the 10-minute just so you can get a feel for what was going on. Look at this movement. Little nuts. But if you go by the letter of the law, right? I mean, we made a lower pivot high. Obviously, it really wasn't completed until this bar because this bar was so huge. But if you go by the 10-minute, you basically had sort of like 410.30. Taking that out would have been pretty important. It was also a pinch play on the hourly. So, I mean, that would have been the kind of the trigger to get in off the 2. Right? Which is what I prefer. If there's no momentum, which there isn't, then I want to sort of enter off the 2. I don't necessarily want to wait till it's 3 or 4 days down and then short. Okay, that's not usually a good entry, and a lot of times what we see is we break that and then we get a retracement back to the 18 after that. So be careful about shorting on the 3 sometimes, especially if it's come a long way. I would prefer to short off the 2, especially if there's a signal. Here's a pinch play, it's divergent. Go look for an entry on this time frame. You had the entry at the failing at the 18, failing there. It's an aggressive play when the Fed is talking and the market's going nuts left and right. All right. So anyway, that's the update for the week. Let me know if you have any questions. Thanks.